All right, just about 1 o'clock. Welcome everyone to our webinar today on OCC's final CRA rule, what it means for your bank. Today we welcome Dr. Ken Thomas. He really needs no introduction. I'll just go through a quick bio of Dr. Ken. So Dr. Ken is the nation's leading expert and author on CRA. He has testified in Congress, advised regulators, trained federal bank examiners, and written numerous articles and 2 books on CRA, including the CRA handbook. Many of its recommendations were implemented into the current CRA regulations. Most recently, he was asked by the Treasury Department, some individual bank regulators, and members of Congress for his input on CRA reform, and some of his recommendations regarding branchless banks are in the final OCC rules. He has worked with banks, regulators, and even community groups in a consulting capacity since the 1977 CRA law was established. He has also launched and acted as chair of the board of trustees of 2 different nationwide CRA investment mutual funds, including the Community Development Fund, launched in April 2016. Dr. Thomas has been on the board of a community bank for nearly 20 years, and it has received 7 straight outstanding CRA ratings from different federal bank regulators. He received his BSBA from the University of Florida, MBA from University of Miami, and an MA and PhD from the Wharton School of University of Pennsylvania, where he taught banking and finance for 42 years. He is a regular speaker and writer in the banking industry, mainly in the American Banker and The Hill, and has appeared frequently on ABC Radio, Bloomberg Radio, TV, CNN, CNBC, MSNBC, and NPR. So welcome, Dr. Ken. We are very honored to have you here today. And just before turning it off to him, just some quick housekeeping on if you're looking to earn CPE credits, just ensure you have logged in individually to the session using your own link as provided to you via email. There will be polling questions so you can earn your CPE credits. You have to complete at least 2 out of 3. They do not have to be correct, but you just have to complete them within the allotted time frame. And you will not earn CPE credit if you log in using someone else's link or join only the conference call, or you do not complete 2 out of the 3 polling questions. So with that, over to you, Dr. Ken.
Thank you, Raji. And first of all, I want to thank Mercadien for sponsoring this webinar. You know, I've done a few previous, actually in-person conferences at Mercadien, and I always prefer to do things in person when possible, but obviously with the present situation, here I am in Miami, and most of you are up in the Northeast or wherever at home, but you know, we just have to do the best we can with the cards we're dealt. I also want to point out that, you know, even though the title is OCC's final rule, my bank, we're a New York bank, a $1 billion bank, FDIC. Even though we're FDIC, this is still very relevant. We'll explain why. Even if you're a Fed bank, you should follow this and be on top of it. So let's go through some of the important comments here. And I would say probably the most relevant thing in my background is the fact that I've been on the board of a bank for 20 years. So our bank, of course, dealing with PPP loans, all types of loan modifications. We're on top of all this. We're up in New York, as I mentioned, New York City. And so we're very much in tune to what's going on in the system. But I have to tell you, in my many years of being in banking, I've never had a period where there's been so much uncertainty. You know, uncertainty is really the enemy of growth and expansion. It's just bad for the economy. We have uncertainty, not just with the economy, with this recession. This is a different kind of a recession than we've had before. Even the Great Recession, we knew what caused that. We knew when it was roughly going to end. This thing, we have no idea when it's going to end because it depends upon when we're going to get this vaccine. And if you heard Dr. Fauci yesterday testifying, you know, he says we'll have something by the end of the year. But, you know, in my mind, until I can go into my CVS or my Walgreens and get my, you know, COVID shot like I get my flu shot, this thing's not going to be over. And that may be well into next year. So the bottom line is uncertainty on the vaccine, uncertainty on the economy. And of course, we have uncertainty with this regulation, as we'll see. And I think probably one of the biggest uncertainty that we'll be facing here that affects everything else is a presidential election. You know, we're 5 months into this recession, which technically started in February, and we're 5 months out from the election. So here we are, 5 months into the recession and 5 months from the election, and that will determine very much, a lot more of this uncertainty. We'll have a better idea of what's going on. We're now going to move through some of the slides, go through these disclaimers, and I'll answer many of your questions up at the end. But first of all, very briefly, I want to just always keep in mind CRA stands for Community Reinvestment Act. Those of you who have read my book know that I like to explain it to everyone in terms of what I call the CRA triangle, where C stands for community groups, R for regulators, and A, I force this, America's banks and thrifts. So think of it as the regulators in the middle, like a referee with two different teams, the community groups on one side, the banks on the other, the community versus the industry. And you cannot have any success on anything with CRA unless you get a buy-in from all three sides. So what we have here, we have community groups actually suing, the OCC on the rule. The OCC is acting alone without the FDIC or the Fed. And then we've got banks, whether you're small, intermediate, or large, taking different views and going to be impacted differently, especially those over 2.5 billion under the new rules. So we've got a lot of uncertainty, even within what I call the CRA triangle. Now, the importance of this slide is to always remember that CRA's focus is on income, not race. One of the issues I have with the community groups and even some people in Congress is that they're trying to force CRA into becoming, or to call it, a civil rights law. CRA is not a civil rights law. ECOA, Reg B, fair lending, those are civil rights laws. Things like truth in lending, truth in saving. This is more for, as Senator Proxmire mentioned, the focus is on income, low and moderate income. It was for the prevention of redlining in low and moderate income neighborhoods, not in majority minority neighborhoods. So the focus was on income, not race, although that's being confused quite a bit. And of course, CRA, I always remind everybody on the board, is not about making bad loans, but ascertaining your local credit needs and meeting them in a safe and sound manner, even if that means saying no. And the final point on this slide about Senator Proxmire, he's my hero, not just because of CRA, but unlike all the politicians we see today on MSNBC, CNN, Fox, they're all on one side or the other. Senator Proxmire obviously was liberal when it came to social causes. He's the father of CRA. But on fiscal issues, he was super conservative. He actually had what was called the Golden Fleece Award to prevent government waste. He was the one responsible for the bailout of New York City, our biggest city. He took over that. And when he did the bailout, he went out and fired the unions. I mean, that's not something a liberal, person's going to do, but he took both sides. He was a fiscal conservative, but, on the Democrat side, he was social justice. He was very much in favor of CRA and those things. We don't have anybody like that anymore. Everyone's either one side or the other at the extreme. And so again, why he's always been my hero. Now, going on, we know the law was passed in '77. The ratings became public after the S&L crisis in '90. And then we know we had the major rewrite with Comptroller Ludwig and his awesome crew at the OCC, people like Steve Cross that I had the pleasure of working with back in '95. The intermediate ISB regs in '05. And now here we are, 15 years after the ISB regs and 25 years later, '95, with the reform by the OCC, but not the FDIC or the Fed. And it's important to keep in mind the differences between where we were in 95 and where we are now. In 95, Gene Ludwig was able to work with the Fed, FDIC, and the OTS. We had 4 regulators then. And the Fed pushed back quite a bit. We had a proposal in 93, Larry Lindsay at the Fed said, tear it up, throw it in the fireplace. We had another one in 94 they didn't like. So finally came back in 95 and there it was. But there was consensus among the regulators and we got it done. Today, we have the OCC going its own way. The ANPR had the FDIC without it, but the FDIC joined at the last minute on the NPR, but then backed out. And of course, the Fed was separate on both of these. Now, the 1995 reforms had over 14,000 comments, 7 public hearings. We have not had a public hearing with this. We've had congressional hearings where they basically, Maxine Waters' committee really went after comptroller auditing and the proposal. But the OCC reform had 1,500 comments in the ANPR and about 2,000 comments on the NPR. That was the joint NPR with the FDIC and the OCC. Now, if you read the OCC release, it'll say 7,500 comments. Well, that's not exactly correct. There were a total of, as you see on that slide, 1,500 ANPR comments and 2,000 NPR comments. I read all 3,500. Where did the 7,500 come from? Well, there were about 5,500 form letters that were not counted. They were just social media. They came in on every type of Facebook platform, thousands of letters, and they just didn't count those. They only counted those that were actually comments with the names of a single person they could confirm and so forth. I will tell you also that with the ANPR, I've logged in all those comments. And by the way, I'd be glad to share my results with you if you're interested. But 22% of the ANPR comments came from banks. However, only 9% of the NPR comments came from banks. The reason being that many banks were very hesitant, especially now with the FDIC and the joint NPR. We're talking about, 85% of all banks, OCC, FDIC. There's no way a banker wanted to criticize OCC and FDIC and have it on record. So they had basically the trade groups do it for them. And we even saw some very unusual things with the NPR. For example, competing banks that never got together. Say, for example, two of the biggest, State Street Bank and Bank of New York Mellon, they had a joint letterhead and filed a joint type of comment. So that way, safety in numbers. In fact, some of the trade associations even got together and did it that way. Even the ABA's comment was signed by all trade associations, whereas the ANPR comment was signed individually. Again, I wrote up a separate piece on this if you're interested in learning more about those details. But the bottom line was there were not 7,500 comments, there were 1,500 and 2,000. Now, let's talk about the objectives of CRA reform. I always follow the old school rule, if it wasn't broken, don't fix it. CRA really wasn't broken. 98% of banks were getting passing ratings. People didn't complain about the 3 tests. There were never complaints about how the ISB test was done. The 50% with the lending and 50% with community development, or the wholesale limited purpose. There were no complaints about that. There were no complaints about the 3 tests on the large bank, the lending 50%, 25 investment, 25 services. And by the way, when I proposed that to Comptroller Ludwig, I had actually proposed something called LIBS, L-I-B-S, 60% loans, and I wanted 20% investment and 20% banking services. But even now with the 50, 25, 25, nobody complained about it. Everything started when, of course, Trump was elected and he brought in industry people, Mnuchin into Treasury, Of course, auditing with the OCC, both from One West and even the current acting Comptroller Brooks from One West. And then FDIC, she was from Fifth Third. And of course, Jay Powell is from Wall Street as well. Now, these are industry people. They're business people. You know, they say the reason Trump was elected because they wanted somebody, not a politician, not a lawyer, they wanted a business person to get things done. Well, right away, they wanted to make things happen. And their focus at Treasury immediately was on CRA, mainly because of their experience at One West. But if you read the 2017 Treasury report, it was about modernization of the law. And every time somebody talks about CRA reform, they'll come out and say, yeah, of course we have to modernize it. You know, back in 95, we didn't have cell phones. We didn't have the computers like we do today. Branchless banking wasn't there. So we need to modernize. Everybody agrees on that. But they use the modernization argument as a Trojan horse to get into CRA to then totally not just tune it up as I would wanted, and we did need a tune-up, but a major overhaul. So I had always been in favor of a tune-up and modernization, but not a major overhaul, and that's what we got. Now, where did we see a difference between the FDIC, OCC, joint NPR, and the final rule? And I heard this directly from, the OCC. When they did the final rule, the FDIC was submitting comments, and these are the very senior people at FDIC, into the OCC up until the very last minute. And the OCC was changing them like crazy to, appease the FDIC. So for example, and I actually put in a FOIA as to what the changes were, the differences between ANPR and NPR and the final rule. I don't know if I'll get it answered, but the point is they withdrew at the last minute, the FDIC, probably because J. Mac realized that, Comptroller was stepping down. But the big changes were they retained all 6 exam procedures. They didn't get rid of ISB like the other one was going to do, and they kept wholesale limited purpose bank, and they kept the strategic plan. Now, the big changes were doubling basically of the right now the 300 plus small bank threshold. Originally they said 500, they went to 600. The ICBA pushed that strongly and the ABA, but especially helpful to ABA and ICBA was keeping the ISB category and going up to 2.5 billion threshold. I mean, that's a long way from where we were back during the day. We were at small bank was under 250 and large bank was over until 95 when we brought in ISBs. Importantly, they kept the 3 new complex large bank tests. However, and this is important, they did not go into the details of what these were going to be, the benchmarks. The benchmarks were very clear in the joint NPR. Remember the 3, 6, 11% on the general test, and then the 2% on the basic test. They removed all those, and it was going to be based upon a forthcoming NPR, which they're working on now. We'll probably see this summer from the OCC. Also, credit for legally binding loan commitments, more credit for retail loans sold, not just 90 days. And that whole thing about the stadiums, it was really unfortunate. The OCC went to all the regulators when they were talking to each other, and everybody said, put together everything that you ever got CRA credit for, FDIC, Fed, OCC, and they created this list. It's 22 pages in the final rule, but one of the things someone somewhere back since 1990 gave credit for CRA credit for a stadium. And it could have been for a Jumbotron. We don't know what it was for, but that one thing stuck out in the community groups in Congress. They were all over it. And so they clarified that, but that just shows you how political this has become, because they made such a big deal over something that was really just something that would already was in the current regs that they had given credit for. And they just said, we're going to kind of codify this and that's what happened. But going on, let's look at the final rule versus the current rule. At this point now, OCC banks are going to be operating in some respects at an advantage and some at a disadvantage. We have an unlevel playing field. You know, this is something that it's not healthy for banking. In fact, one of the things I proposed long ago was taking all the compliance functions, including CRA, and putting it into one agency like the CFPB. So we wouldn't have this competition and laxity among the three regulators, which is what we've got now. So we've got different rules for different regulators. That doesn't make a lot of sense. And now we have deposit-based assessment areas for the first time. Now, I will tell you straight up, I'm very much in favor of this 5% deposit rule, and that's because I developed it. I went back, if you look at some of the articles from 2017, when I met the comptroller, Adin had invited me up to Washington 3 different times. And when I met with him, I made a very big deal about how it was unfair that these big credit card banks based in Wilmington, Sioux Falls, and Salt Lake City are, and we know who they are, I don't have to mention their names, Synchrony, Ally, and so forth. They're taking billions, and in some cases, tens of billions of dollars of deposits out of our major metro areas, like my home county of Miami-Dade in South Florida. And they're taking the CRA benefits of those deposits and putting them back in those 3 sanctuary states because they have better interest rate usury ceilings. Well, that's just not right, because Senator Proxmire called it community reinvestment rule. Reinvestment of what? Reinvestment of insured deposits. And that's what he wanted. And so if you're taking billions of dollars of deposits out of South Florida, let's put back some of those benefits back into South Florida. And I said 5% was a reasonable threshold. And I actually proposed 5% of the benefits should go back into Miami if you take 5% of deposits out, you know, quid pro quo. But they didn't do that. And then they added the 50% requirement that you had to meet a 50% threshold and so forth. But a lot of people were against this rule, saying, well, you're taking the money out of a rich area, Coral Gables, Coconut Grove in Miami, and you're putting it back there. No, you're putting it back into community development activities. So the money would go back into our LMI areas here in South Florida that need help, like Liberty City, Overtown, Hialeah. It's going to go into those LMI communities. So it's almost like a Robin Hood proposal, if you will, you know, taken from the rich areas of Miami and putting the money, the benefits back into the poor areas. So who could be against that? Well, community groups were, some banks were that just didn't understand it, unfortunately. This to me was the most important aspect of the whole reform. Going back to the purpose of Treasury modernization. The report's called CRA Reform Modernization. It's not called CRA Reform Improvement or Overhaul. It's called modernization. And that 5% rule does it. So we could have just ended it right there with some needed improvements and that would have been it. But no, we took the car in for, the engine's running rough and I get a call back, Ken, you need a new engine. I don't need a new engine. I just needed you to tune it up. Well, we got a new engine on CRA. We have increased data gathering and reporting for everyone, even for small and ISB banks. The higher asset thresholds are going to help, but however, you've got to be careful with that because some of those banks might consider, well, we're no longer required to do community development or service tests, whatever, under the lower thresholds. That would be a big mistake. I would keep where you are in at least until 2023, 2024, when the new one would become effective if you're OCC. And finally, strategic plan option was untouched. Let me say something about that. Actually, I have 5 different comments in the NPR, and you can go to regulations.gov, put in my name and you'll see them all. The one option that they proposed to leave untouched, strategic plan, was the option I had proposed back in '95 and now to be eliminated. Why would I eliminate strategic plan? Only if they didn't improve it. I would be in favor of keeping strategic plan, but it needs improvement. So for example, since we started CRA, the average, maybe 10% of banks on average get outstanding. However, if your strategic plan, that number is 40%, about 4 times. Well, that's pretty good. But why is that the case? Well, here's the other problem with the strategic plans. And if you look at them, and actually I mentioned Ally Bank, if you go to their strategic plan and you look at their appendix, they've compared a lot of them. The actual goals for satisfactory and outstanding, they vary as much as 4 times. Some banks can do, say, 1% of assets to be outstanding. Other banks can do maybe 25 basis points to be outstanding. There's no similarity, no comparability of the goals. You basically come up with your own goals. You get a friendly community group to sign on to it, assuming you've worked with them, given them a donation and they're friendly and they sign up with you. Well, and then the regulators approve it. The strategic plan option may be a very popular option for a lot of banks under OCC's current rule if they don't like going in that direction. I could always talk more about that, but let's keep moving forward here. The most radical changes, of course, are for those banks, the large banks now over 2.5 billion. Obviously more quantitative. Instead of the 3 simple tests, lending, investment, and services. And when I say I wanted improvements, I wanted something like on the lending test. Very simple. If you've got 80% loan to deposit ratio, outstanding. If you've got 80% within your assessment area, outstanding. On the investment test, 1% of your assets, outstanding. And then I have high SAT, low SAT, and down the line. That's what we needed. We needed some improvement of those 3 simple tests that were working. Now we've got 3 complex tests, which we'll get into in a minute. We have separate tests for banks for the bank versus the assessment area. We have to come up with our own presumptive ratings. Now we've got call report data for quantification of the activities, and the multipliers, I believe they're controversial. For example, I would argue we've always had multipliers. Why? Because the subjectivity that we've given our examiners to go in and say, okay, we'll give you CRA credit for that loan, but we believe it's particularly responsive to community credit needs. We believe it's innovative, so we're going to give you extra credit. It was never like 2 times or 3 times, but that was the multiplier. So to say we didn't have multipliers is wrong. We did have multipliers. They were the subjective things, innovative, flexible, creative, that examiners gave us extra credit for. Those were the multipliers. We didn't have 2, 3, 4 times like that, which is a problem. And now we've got grouping of CD loans and investments together in one bucket when we do the quantification of activities in these 3 tests. Before, we made sure that you do a little bit of each, 50%, 25, 25. Now, especially services are going to be hurt because there's no special category for them except for that little 0.1, 0.2 tie-in in the numerator. Importantly, targeted investments for CRA, more important than ever because some will get multipliers and some won't. We'll talk about that more later. Now, these 3 tests are really complicated. I mean, complex. And we have the evaluation measure, which takes everything, all your loans and investments over deposits with a little bit of credit for LMI branches, no credit really for CD services except for the hourly add-on you're going to get into for the activities and so forth. But the bottom line is there's no benchmark like we had before. We had the 3, 6, and 11%. Now that's for both the bank and the assessment area, as is the CD minimum ratio, which is just CD activities alone over deposits. That used to be 2%. We don't know what that's going to be now. We have no benchmark. And then finally, we've got the separate retail lending borrower and geographic distribution tests for major retail lending product lines for the assessment area. And you must get, it was 50, now at least 80% passing to get a passing. And then we look at the comps, whether it's the demographics or the peers. And before it was like 55, 65, and again, we've taken those numbers out. But the result is we get a presumptive rating. A presumptive rating adjusted by examiners for performance, context, and fair lending. Let me stop and make a point about fair lending. And stop and take a sip of my monster drink. When we did the 95 regs, in my opinion, there were two important benefits we gave banks. And, you know, being a banker, and I always explain this to other bankers, there were first, the ability to create our own assessment area, and second, the performance context. Now, for the first time, they're saying assessment area is going to be, has to be a minimum of a county, which is going to be very difficult for a lot of banks in big counties like LA County, where they only have 1 or 2 or 3 offices. It's going to be difficult for banks that really cannot serve the entire county. So now we have some direction. Remember REMA, FDIC? They could tell us what our REMA is, but we always said this is our assessment area, and our board determines that. So now we've got input on what the assessment area should be at a minimum, and also we've got the 5% rule. I have no problem with that, of course, because if you are taking money from somewhere, you should have a deposit-based assessment area. Now, the performance context, it's really important that we keep this in, because every bank, including my bank, for example, we focus on construction lending for affordable housing. In fact, my bank has the highest construction lending to capital ratio in the nation, highest CRE ratio in the nation. Yet we've had no problem loans ever with a construction loan. We've got 15% capital, 55% efficiency ratio. We're 1.6 ROA. So we're making money, everything's fine. But the point is, we have to be judged by that particular business strategy, by our business plan. Every bank is different. So that performance context is so critical to explain to an examiner. And if the examiner is wrong and gives you the wrong rating, it's usually because you didn't do a good, a CRA audit in advance, or you didn't do a good job explaining your performance context as to why your bank is doing a good job. But those two things are critical. We've lost some of the flexibility on the assessment area, but performance context remain. And as long as that remains, you have an opportunity to be able to make your case, and that's very important. Well, like everyone else, what do you do at night? You've watched all the Netflix movies, you watched all the Prime, Billions has stopped, they've stopped it at episode 7. Narcos is gone. All my favorite series are gone. So I'm going back and watching all my favorite spaghetti westerns. This is by far my favorite. I remember growing up, my dad used to say, a real man is like John Wayne or Clint Eastwood. He said, I had 4 brothers. We had 5 boys. Those are real men. John Wayne, Clint Eastwood. And I loved everything Clint Eastwood was in. Dirty Harry, even the new one he did in Detroit, where I was born. I love that movie. But I always go back to these 3 categories, the good, the bad, the ugly, to try to explain different things. So for example, what is good about this new proposal? Clearly the 5% rule, and I explain why. Mainly because I developed it, but also because I think it's critically needed and it's unfair. And you know where most of that money is going to go? We're going to take money, for example, out of Central Park, the quote rich areas of New York, and we're going to put it back into Queens, the LMI areas of the Bronx. These are the areas that are just not LMI, but these are the areas most hit by COVID-19. And these are mainly communities of color, which if anytime we ever needed help to these areas, it would be now. So again, who could argue with this? Yet one of the congressmen from Queens, he actually was against the OCC's rule in general, but this is a good part of it. They maintain all 6 exam procedures. This was very important. And I think this was one of the reasons why the FDIC was into the end on the NPR, because they kept everything the way it was, put those back in. and they got the ABA, the ICBA, I think, to get support for them. But that was very important, keeping all 6 exams: wholesale, limited purpose, strategic plan, a small, large bank, and of course, ISBs. The focus on CRA deserts and a list of them. And by the way, I just got an email today, the middle income areas, distressed and all that, from the FFIEC, the Fed, FDIC, that came in. And the list of approved activities, this was really important. Now, some of my friends in the field say, well, Ken, this is not good because you just go to that list and do that. It's going to take away from being, innovative. But I would say, no, a list is good. 22 pages is good. And then we have, in addition to the list, a way we can go in and say, is this going to qualify? And if by a certain time it doesn't get an answer, it's automatic, that is all good stuff. And as I said, very critically, maintaining the performance context. If properly understood, if properly explained to the examiner, and remember, this is your job as a CRA officer, compliance officer, not the examiner's officer. Remember, you're just one of many banks they go through and check off on the list to get done. You have to explain why your bank is different, why you deserve outstanding or satisfactory in different tests, why something is CRA eligible and so forth. That's so important, and that's all performance context. Now, what are the problems I've got with the test? Well, with the new rule, I would say the next one would be, we go to bad here. Reduce community development activities for the increased banks and the increased asset size threshold. Let me explain. So now, moving up to 600 million, if you or previously were an ISB and now you're a small bank, you'll say, well, this is great. I no longer, because I'm under 600, I no longer have to worry about the community development test. It's just a 4-ratio lending test. The loan to deposit assessment area and then LMI geography borrower, period. That would be a mistake, because I believe examiners are going to come in. Remember, any exam between now and 2024 for an ISB or small bank is going to be under current, and for a large bank up to 2023, that would be a mistake to cut back. First of all, it won't look good to the examiner. Second of all, and this, by the way, is also the case for those previously large banks that are now under 2.5 that no longer are large bank with the 3 tests and now just go to CD test, which is just the 50% lending test as ISB or 50% CD test. Now we no longer have to make these investments or do this. That would be a mistake. First of all, the examiners are going to say, well, you cut back. That's not good. Because what does the examiner do? First thing they do, they look at where you were in the previous exam, and they look at your internal, your self-audit, where you think you should be. So that would be a mistake. Second of all, it's a mistake because the community groups are not going to be liking it if we cut back in any area. So if we are now a small bank and we were an ISB and we're no longer giving grants to community groups because it's not required under the small bank test because we only have lending, that would be a mistake, because these community groups count on our money, our donations, on working with us on financial literacy. And third of all, it's not good for our communities. If we've been supporting churches and food banks and other good CD activities and we cut back because now we're at a lower threshold, that's not good. That doesn't make sense. And I think it would be bad reputational risk too. So that's an area where I'm nervous about banks cutting back. That would be a mistake. Also, the weighting of the 3 tests. We had 50, 25, 25 on the 3 tests. Those weightings are going to go away. Those tests are going to go away. But we should still have a good balance of what we do across the board. It would be a mistake just to be focused on, this is a legitimate community group complaint, a big bank just doing a big loan on a sewer project, or I don't want to say stadium, something like that, to get the ratios up, when they're ignoring investments like helping a minority bank with a CD or affordable housing or LIHTCs or especially service tests. So that was a mistake, I believe. Not having thresholds for the new tests. This to me was I would almost put as ugly, but let's remember back in high school when we were taught the scientific method. What was the scientific method? Remember that? We would first define a problem, we'd come up with a hypothesis, collect data, come up with a preliminary conclusion, test it, do analysis, and then we do a recommendation. Well, we did it the opposite way here with the OCC. They came out with the conclusion first, and now they're doing the data collection afterwards with this new NPR that'll be coming out. They did it backwards. The Fed hopefully will do it right. They've got this new database now. They say 6,700 PEs they've looked at. And this is the largest exam of PEs that's been done since I've examined several thousand in my CRA handbook. It's just dated. So it's good somebody is doing that, but the tests have to be based upon data. You know, when we listen to Jay Powell at the Fed, what is he talking about with the FDIC? What are we going to do with interest rates? Well, we're data driven. It depends on what happens with COVID, what happens with retail sales, the economy, unemployment, inflation. What does Dr. Fauci, Dr. Burke say? Well, you know, what our recommendations are going to be dependent upon the amount of hospitalizations, the amount of deaths, it's all data driven. Scientifically, we have to look at these things based upon data. So we do the data first, and then we do the analysis, and then we do the recommendations afterwards, not reverse. So we were doing it in reverse there. Number 4 here, the subjective, I'm basically against the whole multiplier concept because we already have it, first of all, with the subjectivity we allow examiners. But second of all, the way they set it up, they're penalizing mortgage backs. Now, I would argue any community that you are in right now, but especially New York, where I am, Miami, and San Francisco, the most important community credit need, without a doubt in those areas, affordable housing, and probably in most every other community that you're in. And how do we provide affordable housing? Through low and moderate income loans. And we don't keep those loans on our books, we sell them. We go into, put them into mortgage-backed, securitize them, and they're traded into the market. And those mortgage backs are what allow this LMI activity to continue to grow, to help affordable housing, both single and multifamily. The idea that we're now going to penalize that, and even some municipal bonds that help affordable housing, makes no sense. In fact, I had an entire commentary you'll see online about why this was so dumb. And in fact, I traced it back. I said, where did the OCC come up with this idea? I traced it back to, you know, we go back to case number 1, COVID case number 1 in Oregon. Well, I went back and traced it back to one community group, one person at a community group in Southern California, who she decided that banks flip-flop these things. They buy mortgage backs, and after the exam is done, they sell them to another bank. That's not how it's done. Every mortgage bank, I could tell you, in the Community Development Fund, we've never sold. We keep these to maturity. We don't flip them and trade them. And there was no reason to do that. And that was a big mistake. And finally, the countywide assessment areas. Again, this could work in rural counties, but in big counties, very, very small banks, this is unfortunate, and this is not a good idea for them. That rule, that, remember the 2 important things, assessment areas, performance context, should have been left to us, the bankers, with the exception of the 5% rule. Now, what did I not like the most? What, in my opinion, was absolutely the worst? And I would say, if I had to say anything was at the ugliest level, there are a couple of things I would pick up, but I would say the whole concept of what we did. You know, Ken, I've got your car in here. You said there was a noise. When you took it on I-95, you were getting some noise. I hate to tell you, Ken, but we need a whole new engine. Excuse me, time out. I didn't ask for an engine. I wanted you to tune it up. You know, the modernization is what we were supposed to do. We did that with the 5% rule. And we could have tuned it up. We could have kept those 3 tests and used like the 1% rule for outstanding investments, 1% of assets. Those would have been tune-ups. We didn't need a complete overhaul. Unnecessary. Second of all, the regulatory burden and costs. You know, CRA back in the 90s, it was an issue of regulatory burden. we had a very good study done by the St. Louis Fed using 2016 data, where they looked at every major compliance cost. And you know what's number one? Not CRA. CRA is like number 6 or 7. Number one is BSA. That's where we need help. If somebody's coming to Washington and is going to help business, and it's going to be a business kind of administration, we needed help on BSA. There are banks, not just here in Miami, but up in New York, that have 10% of their employees in BSA. Now, one of the things we teach at Wharton, we have cost centers, profit centers. BSA is a total cost center. Even with CRA, we could say we're outstanding and nobody cares about it, but we could at least brag about it. What are you going to do with BSA? We comply with it and we haven't gotten an enforcement action. We don't, that's not bragging about it. That's where we needed help. 21% of all compliance costs were BSA. CRA was only 7%. So we didn't really have a regulatory burden there, but now we will. This is going to cost the average bank, the small bank even, because even small and ISBs have to collect data on their deposits and their loans. I would argue, however, if any bank does not know where the deposits are coming from right now, at least on a zip code basis, then I would have a problem with that bank. Deposits are our livelihood. That's the raw material of a bank. And if we don't know where they're coming from, shame on us, okay? So we should know that. And we should know where our loans are, period, with or without HMDA. So that's not an issue, but the big burden is going to be on these banks, with the large banks. That could be easily up to $1 million or more each. For the bigger banks, much more. Also, I found very ugly was the action of the community groups. I don't want to pick out anyone in particular because NCRC has done a good job in a lot of respects. But before anybody had a chance to even download the final rule, they came out with an announcement that they were going to challenge the rating, the new rule. Now, one of the things we teach at Wharton, among other things, negotiation. Trump always brags about Wharton and he's a good negotiator, but rule number one in negotiation is you don't start off a negotiation by saying, I'll see you in court. And that's exactly what NCRC and the group that they're working with that lawsuit did. They should have come in, especially now with the new comptroller, and sat down and say, look, let's talk about what we want. Brian Brooks is a person that would, I'm sure, want to negotiate things and talk. What will it take to get you on board? Comptroller Adi made a lot of adjustments to get the FDIC on board. And up to the last minute, they made changes in the NPR into the final rule. So you negotiate those things. You don't negotiate by filing a lawsuit. And then look what Congress did. They've got this other CRA challenge, Congressional Review Act, which is mainly going to be symbolic because it's not going to get through the Senate, or certainly the president won't sign it. But the problem I have with that is it's politicizing CRA too much by calling it a civil rights law when it's not. And we didn't have this issue back in '95. It was just what was best for communities that are LMI. Now, I would say the fifth thing that I was really disappointed with, and I made a big issue when I spoke to the comptroller and his team. I said, look, outstanding rating, it costs every bank some money. And if we keep wanting to keep these outstanding ratings and costing the bank money, that's money taken away from other areas. Give me some financial motivation so I can go to my board and say, we're going to have lower FDIC costs, assessment costs on our deposits. We're going to have lower costs at the advance window or the Fed discount window. We're going to have tax benefits. Give me some dollar and cents benefit, some financial motivation for an outstanding rating. And what did they say in the NPR? They're going to give us, I've always argued this. I've gone to the comptroller, head of the FDIC. I said, look, why can't you at least send out a letter, a one-sentence letter, congratulations on your outstanding rating. Don't say anything about safety and soundness. They wouldn't even do that. Finally, they're going to do that. What's the harm in giving some pat on the back, good boy, attaboy, but let's make it a financial motivation. Until there's financial motivation, I don't see anything that's going to motivate a lot of banks to do a lot more. Now, where do we stand with all this with the Fed and the FDIC. I've heard from very good sources at the OCC that the FDIC was on board to the very, very last minute. They were taking in their suggestions into the final rule up to the last minute. So a lot of what the FDIC wanted in there is in there. So it's possible, but not likely, maybe 25%, whatever, that the FDIC may join in. Probability that the Fed's going to come back in is probably between 0 and 0.00001. They're not going to do anything. They're going about it in a different way totally. Both the FDIC and the Fed will carefully monitor what the community group lawsuit and what the CRA challenge is going to be in Congress. Last week, when asked about CRA, Chairman Powell said, quote, "We're still working on it. We will ultimately move forward, but can't say when." Well, I have a pretty good idea of when is like in 5 months after the election, but the Fed's approach, hopefully, as I said, will be data-driven with their huge database. That's going to be good news if they do it right. But I believe ultimately they're going to wait until the election. Because and right now it was 12 points and now we're seeing Biden 14-point ups on Trump, I don't really believe these polls because, quite frankly, and I don't want to talk politics here, but, a lot of people will say, yeah, I'm not going to vote for Trump, but then they'll go into the booth and they'll vote for Trump. So I don't put a lot of weight in polls. But for example, if Trump is not reelected and Biden is in, this whole exercise on CRA, modernization, improvement, or whatever it was, is going to be like a ASP, Advanced Study Project. It was a nice exercise, but it's going to basically go away. We'll probably go back to a status quo that everyone wanted with some improvement, and hopefully they'll keep the 5% rule with some improvement. But the election is going to be critical. And what does this take us all back to? Well, what we really care about is, and I appreciate your spending this time with me to this point, what do I do for my upcoming exam? Now, we had a couple questions on this. Your current exam procedure will be in place, which will be your next exam, up until January 1, 2024. You'll have to look at some of these data collection efforts, which are really no big deal for a small bank or an ISB. Large banks would be in by January 2023. Now, this is important. And I said at the beginning why non-OCC banks should be listening to me. I believe examiners at FDIC and even the Fed are going to be thinking in the back of their mind about this final rule of the OCC. So I propose every bank, and I've talked to all the banks that are investors in our fund, and I've recommended this, that they do a shadow exam as an OCC large bank. Even if you're an ISB, even if you're a small bank, do it. Why not? Because if you're an ISB and your exam is next year, like my bank, I have FDIC coming in next year. And I'm going to say, guess what? We did an exam for my bank as if we were a large bank. We did the 3 tests for the 2 assessments. We have 2 assessment areas. And this is what we came up with. We're outstanding. We did 15%, whatever. And then I said, well, Ken, that's irrelevant. Those are OCC rules, you're FDIC. I said, I know, but it's just the FYI. If we were under the large bank rules, if we were FDIC under that rule, this is what it would have been. So I think that's a worthy exercise to do and to share with your examiners. And if the results aren't good, maybe you go back and say, well, what do we need to do to make them better? Because what if the FDIC joins up? If Trump is back in, the FDIC is going to jump right back on, I believe. I'm pretty sure that that's going to happen. So why wouldn't you do that shadow exam? Avoid these gentrifying loans and investments. And what those are, very simply, are loans to middle or upper income people and LMI tracks. So for example, and I'm not going to talk a lot about our fund, but every single investment in the Community Development Fund is low, moderate income borrower. There's not one in there that's a middle or upper income. And I will also tell you on the last point, targeted CRA investment. Now, I just told you CRA is separate from fair lending. We've gotten a request from a number of banks with the current environment. And you've read with the big banks like B of A, what they're doing $1 billion pledge toward inclusion, economic inclusion. This is all good. However, if you're $1 billion bank, you can't make $1 billion pledge. But what you can do is do what we do best, fair lending, fair banking, and supporting affordable housing. So we've got a number of banks that have come to us and said, Ken, could you put together a mortgage back, say for $1 million or a few $1 million in this particular county, say Essex County, or in Westchester County, whatever, that's totally LMI borrower and also community of color, majority and minority census tracts. And we're able to do that. I've spoken to our people at MetLife, our sub-advisor, and we've already put some of these together. So if somebody said at the board, well, what are you doing, for what's going on? What are you doing for it besides fair lending, fair banking? Well, we've made some additional targeted CRA investments, not just in LMI communities, but in LMI communities of color. And we believe that's important. Again, targeted investments. Now, with that in mind, I'm going to end where I started off by saying all of the uncertainty we have, and this is true with CRA reform. We don't know what acting comptroller Brooks is going to do. We don't even know if he's going to be in there in 5 months. We don't know what the FDIC or the Fed's going to do. The NCRC in their lawsuit, what's going to happen, the CRA challenge, and most importantly, the presidential election, what will happen there. Again, I've never seen so much uncertainty, and particularly uncertainty as it relates to CRA. But the best way to protect ourselves is to cover all bases, and that means let's do that shadow exam. And I'm going to do it for my bank next year, as if I was an OCC large bank. I'm going to do all those tests for my assessment areas, and I believe we're going to come out outstanding. They're going to say, Ken, irrelevant. You're not OCC. You're not even a large bank. I say, yeah, but guess what? If we were, we would be outstanding. I just want to let you know that, go back to your work, goodbye, whatever. Anyways, with that in mind, I want to once again thank Raj, the people at Mercadien, and all of my friends there. As I said, I've worked with them for a long time. They've always been my go-to group. If I've ever had a question at the bank, I always go to Mercadien. And thank you for spending the time and sponsoring this event.
Likewise, Dr. Ken, very informative presentation. You are right, cutting back is not good. And, some of the key takeaways is, to remain balanced and, try to err on the conservative side because, we're still trying to see how this is all going to play out, especially, this year being an election year. So all good points. Thank you again for the, for this very informative session. So we did have a couple of questions, Dr. Ken, on the Q&A. That just came in, and also some was submitted in advance. I know we are kind of like coming up to the hour. I know some of them wanted a copy of the slides, so just wanted to know what your policy was on that.
Sure. Well, for example, I have one question came in from Forrest. How likely are the FDIC and the Fed rules to be different from the OCC rules? With Biden in, what would happen? I believe if Biden was in, they would definitely withdraw the OCC rules. It would pretty much be status quo where we are. The Fed has been doing this all along, playing a wait and see game. You get the ball and, fourth down, we're going to punt. Just keep kicking it down the road. And COVID obviously was a good, legitimate reason why we should have delayed a lot of this. And 5 more months, look how much time we've already been, 5 months into this recession. So I think they're going to wait on that. If you have an exam coming up in 20 up until 2022, it's going to be under the current rules, but you do need to have that data collection, and it's no big deal. I'm talking about collecting information about your deposits and your loans, but once you get into 2024 for a large bank, a small intermediate bank, you'll be under the new rules if you're OCC, and if it's a large bank, it'll be 2023. The slides will be available after the session. And again, if there's questions I did not answer, you can feel free to contact me directly. Those of you who have been to previous Mercadien seminars know that I always get back. It might not be a day or two, but I always get back with an answer. And I'll give you a very specific answer, not just a general Federal Reserve Greenspan Fed speak answer.
Very good. As Dr. Ken said, if you had any other questions come up or you think of anything else, feel free to email us and we will get you the responses. You'll receive an evaluation at the end. So please do complete and send it back to us so we can give you CPE, and you will get the certificate 2 weeks from the date of this webinar. So with that, thank you again, Dr. Ken, for your time. Thank you all for tuning in, and stay safe.
Thank you all, and thank you, Raj.